Once again, it's David Moore with IRA Advantage, and thank you for joining us today. The title of today's presentation is Buy What You Want to Buy with an IRA. And actually, it's with a 401k plan too. But the information that we're going to present is all things that have always been possible. It's not something new. Actually, there I am. You do get to see me. So, hey, it's all working. Anyway, we've got a lot of information as usual, a lot to get through, and I probably am not going to get to questions during the presentation. If you have them, please don't hesitate to reach out. You can post them on the sidebar and we'll address them after the presentation. Also, if you are in real estate and you need continuing education, it should be good for 1 hour. And you can reach out to C Moore, C-M-O-O-R-E at IRAadvantage.net or Moore at 1031exchange.com, and she'll get you taken care of with CE. So this is something that I really enjoy giving these classes. It's a lot of fun working with the IRA stuff. As you probably know, we've been handling tax-deferred exchanges since 1991. We've been handling retirement accounts since the mid-2000s. And I guess what I'd like to say is, if you're contemplating a transaction in the taxed world, if you're disposing of relinquishing a piece of real estate, you want to keep your money yours moving forward, obviously the 1031 is a great tool to do that, and we're happy to take care of you with our sister company Equity Advantage at 1031exchange.com. And today's presentation, we're obviously talking in the qualified money context. And so we're talking to you through IRA Advantage, and that firm provides consultation on different transactions with retirement accounts. So we don't make investments, we don't sell investments, we don't provide investment advice. We simply provide the vehicle, the investment vehicles necessary to get you out of what you don't want into what you do want. If we're looking at the IRA 401k context, really we're just looking at a situation where we're opening your horizons to the entire menu of possible investments, not just what is available through your regular Wall Street investment portfolio. So once again, when we're doing these transactions with IRAs and 401k plans, if it's an IRA transaction, you want to use IRA funds to go out and make a given investment. I'm going to encourage you to continue to work with your Wall Street advisors with everything else you've got. This is a diversification play. It just opens up your once again investment horizons, and keep your Wall Street stuff with your Wall Street people, and then we're going to help you get into what you want to get into when it's stuff that the street doesn't sell. So I hope you find this class helpful, and hopefully we're going to give you some good little nuggets of knowledge, and away we go. So what is a truly self-directed IRA? We hear that term a lot. We see it on TV, we hear it on radio, we read about it in the newspaper, and a lot of firms offer what they deem to be a self-directed retirement account, self-directed IRA, or self-directed 401k plan. I sort of have a little pet peeve with that term, because they're not truly self-directed accounts. A truly self-directed retirement account's an account that's going to allow you to buy literally anything the law allows. And it's sort of interesting in the IRA 401k world, the rules have never changed. This is not something that's new. It's always been possible. It's just sort of a well-kept secret. And it's one of those things, just there's not much information out there on it. And if you're looking at IRAs, every IRA has to have a custodian, and you know, back to what Team Advantage is, we're not a custodian. We're an IRA facilitation company, just like we are a 1031 facilitator in the Equity Advantage context. So we're not going to sell investments. We're not going to provide investment advice. We're going to listen to what you have and what you want to do with it, and hopefully we're going to be able to provide you an investment vehicle that allows you to get where you want to go. And if we're talking about IRAs, we can do a basic self-directed IRA. We can do what's called a checkbook IRA. If we're talking 401k plans, we can do solo 401k plans, or solo Ks they're sometimes called. If you said, David, hey, maybe we lost our job, maybe we want to go out and create a new business. Well, there's something called a rollover business startup, and that's even possible for us to create a new business using your retirement account. So there's a whole very, very large menu of opportunities out there that are just not, sort of out there for prime time observation. And you don't know what you don't know until you start looking into it and talking to people that have some background in this space. So there's no such thing as a dumb question. The only dumb question is one you don't ask. If you've got questions on this stuff, the best piece of advice I can give you is take time. It takes time to understand what you can and can't do. I mean, we're going to go over some basic rules today. But when we really look at what we're going to do, take the time to plan it. This is your retirement. And it's critical that you do it the right way, because if we're looking at let's say a Wall Street investment, you can make a poor investment decision, but you cannot really commit a prohibited transaction. And in our truly self-directed world, there's really very little in the way of guardrails. So it's very, very important that you sort of research and plan out what you want to do before you move forward. And a simple example of taking the time to do it right versus screwing it up is, let's say you found a piece of property, you talk to somebody and say, oh yeah, you could use an IRA to go buy this piece of property. And if you're not ready to go make that offer, you should not make that offer. What I mean by that is, if you tied up the property personally and then signed that purchase sale agreement over to your IRA or 401k plan in the future, that would constitute a prohibited transaction. So you need to make sure the investment vehicle is structured correctly and ready to go before you start going out and getting things, your ducks in a row to go buy these things. Don't get over your skis and tie up an asset, tie up an investment before you're ready to do it, because that act, the reason that's a prohibited transaction is you pulled that thing off the market personally, and then even though the purchase sale agreement's assignable to you, you say, well, hey, it's an assignable purchase sale agreement. Where's the problem there? The problem is that you personally took the property off the market and then conveyed that purchase sale agreement to your retirement account, which benefited the retirement account, which therefore constitutes a prohibited transaction. And you don't want to do that. The repercussions of a prohibited transaction are devastating. We'll talk about them in a little while. So really take the time to research what you're doing. Give us a call, go over things. I mean, we're free consultation. Give us a call. We're going to go over things with you, talk about the do's, the don'ts, our concerns if we have them with what you're doing. We're going to talk about the type of product that's going to fit your situation. And once again, I'm going to throw that back to the 1031 side of the businesses too. 1031 is over 100 years old at this point. And the problem is, that I see is people just sort of flippantly treat it as something, oh, we'll just do it as an additional closing function. And well, anybody can handle this exchange. Well, that's not true. I mean, you really have to understand what you're doing and make sure, validate your direction. Make sure that it warrants the exchange. Make sure that it's going to get you where you want to go. And what we're seeing in the market as it gets tighter, for example, is a delayed exchange is sell first, buy later. Well, a reverse exchange allows you to buy first and sell later. And in today's world, we might have financing that blows up on something. Maybe your sale goes away and you still want that property, that target replacement property. So somebody just said, well, hey, just buy it and then do a reverse later. Well, you can't legally own the new and old property at the same time. So the fact that you bought that thing without having the exchange structured takes that property out of your menu of options for a future sale, unless it's structured as an exchange and set up as an exchange before that purchase. Well, in the IRA world, once again, any IRA, they came to be in the mid-70s, so it's a much, much newer thing, but it's very, very complicated when you look at the little nitty-gritty details. And we're going to boil it down to what I consider two basic things with IRAs, and we're going to talk about four basic things with 1031s also. But when we're looking at self-directed account, a truly self-directed account, once again, is going to allow you to go buy anything the law allows, and a solo 401k is going to literally allow you to go out and buy anything the law allows. Typically, any restriction you've got, if you've got an IRA today and you said, look, David, I'd like to go out and let's say buy cryptocurrency, for example. If your current IRA doesn't allow that, it's not by law, it's by that custodian or that investment firm's direction. They're not going to allow you to do it. If it's a 401k plan that doesn't allow that investment, Well, it's either by plan document or by the administration of that plan. One of those two things are the limitations. So if we're looking at making that change in an IRA context, all we're going to do is move the money you want to use to go buy that crypto from the trust company that you currently have or the investment advisor you currently have into a new self-directed account, and then that account can go make that investment. If we're looking at that 401k plan, we're either going to say, well, gee, since the plan won't allow it to happen right now, maybe your third-party administrator, TPA, will allow the investment to be made, but the plan doesn't allow it. Well, can you amend the plan to allow that investment? If you can't amend the plan to allow that investment, you replace the plan. But a lot of times, even if the plan may allow it, the TPA, the third-party administrator, won't want to deal with some of these items. So a solo 401k is what we would call a self-trustee plan. And you are literally in charge of that thing. You're the trustee of the plan. You want to go buy crypto, you go do it. And I'm just using crypto as an example. I mean, it's sort of been entertaining to me over the last, I don't know, decade or so. 1 year it's a great thing. The next year it's absolutely not. And it goes up and down. But I'm just using that as an example of something that's possible to go buy. Typically people come to us if they want to go buy that kind of stuff. They want to buy precious metals. They want to go buy real estate is primarily what people come to us for. And a lot of people are interested in making loans, buying notes, that type of things. But there's all kinds of other investment opportunities out there. At the end of this presentation, we're going to talk about a few of them where you can take and self-direct money into these different investments that are well outside Wall Street's typical menu of opportunities there. So I've got a good buddy in my Rotary Club, Ed Popkin, always says, if you never ask, the answer is always no. So once again, ask the questions there. So any IRA can be self-directed. Any IRA can be self-directed. And really, there's a variety of different types of IRAs too. And typically, we're going to look at two types. We're going to look at the pre-tax type of IRA. Traditional IRA is pre-tax money growing tax deferred until at some point you take that money out. You're paying taxes as you take distributions. At 72, you've got to start taking those distributions. If we're talking about a Roth IRA, for example, that's taxed money that's growing tax-free. And that's a totally different situation there. If we're looking at somebody wants to, let's say, create a self-directed IRA using a 401k plan, it's really going to be a much, much different situation. So any IRA can be self-directed, but if we're looking at 401k plans, if you're under 59 and a half and the plan you want to self-direct is a current employer plan, you're not able to take that money. If you're 59 and a half, you can take an in-service distribution. You can use the money as you choose to use it. If it's a previous employer plan, you can use that money in a self-directed capacity, and we can establish an IRA with those funds also. But once again, any IRA can be self-directed. We're talking about 401k plans. If it's a current employer plan and you're under 59 and a half, you're stuck. If you're over 59 and a half, you're entitled to an in-service distribution. Previous employer plans you can use. I've had people literally quit their jobs to get access to stuff. I've had business owners step away from their job to get access to their funds to self-direct different investments. So it's one of those things where we're going to work with your tax or legal people to make sure that we're getting you where you want to go with this stuff. So how hard is it to create these things? It's really simple, okay? So it's very easy to create that investment vehicle. It's just that you've got really, as I said earlier, no safety rails there. You've got to make sure you're asking the questions, working with people who are going to help you stay on the road, go in the right direction. Because if you committed a prohibited transaction with a self-directed IRA, for example, all funds in that account, all funds in that custodial account are treated as distributed as of the first day in the year in which the indiscretion occurred. If we're talking about a 401k plan, it's a totally different consequence for a prohibited transaction. Only the funds involved with the indiscretion are treated as distributed. So really, it's critical we do things right to establish these accounts. It's very easy. If we're looking at a basic self-directed IRA, for example, you're just going to move the funds from custodian A that doesn't allow you to do what you want to custodian B that does. and it's possible to establish one of these accounts. You don't need us for that. People pay us every day to establish a basic account, but you don't need us for those things. You can go to any self-directed custodian is probably going to have an online application process that you can establish that account, and typically they're going to require some forms of ID. They're going to require information on your current custodial accounts and then what you're going to want to invest in and so on and so forth, and they're going to create the appropriate custodial account. If you're engaging our firm to do this, you're going to fill out a 2-page application for this thing, and it asks your contact information, types of accounts you're using, what you're wanting to do with the money, how much you want to use. And then if you're looking at, for example, a checkbook IRA LLC, we're also going to want a name and state of registration for a limited liability company. We're going to put all that stuff together too, the operating agreement, federal tax ID number for that thing, but the articles for the state. But really to put a basic self-directed IRA account, it's really a simple process. You just move what you want to move into the new custodial account, and then to make any investment, you have to submit the investment to the trust company, and then they'll make the investment after they approve the investment. As I said, if we're talking about a checkbook IRA, it's more complicated. We've got another page that we're going to talk about this in a few minutes. 401k plans. As I said, we're going to look at the plan. If the plan doesn't allow the investment, can the plan be amended to allow the investment? If the plan can't be amended to allow the investment, you replace the plan. So anything's possible, as my wife likes to say. So if we're looking at any IRA, okay, so if we're talking about a 1031 exchange, and I'm sure a lot of you probably handle transactions with us too on that side. And if I look at any exchange, 4 basic things have to happen. One, it's got to be an exchange. 2, what's going to receive have to be of like kind. In order to be totally tax deferred, you need to go across or up in value and equity. And finally, we have to have continuity of vesting. That means the person already that gave us something has to be given something back. If we're looking at a retirement account, you've got 2 issues. 2 issues, all right? What do you want to invest in, and who are you transacting between or for the benefit of? And when we're looking at what you want to invest in, it's virtually limitless. The way the law works, unless it's specifically prohibited, it's therefore allowed. The only thing prohibited from investment with an IRA are collectibles, life insurance contracts, and stock and sub S corp. If we're talking about 401k plan, the sole restriction is collectibles. So it's really virtually unlimited what you can do. Now, you can move all your money into a self-directed IRA and then go open an investment account for that IRA in the LLC's name. But I'll just warn you, it can be difficult. But furthermore, I would recommend that you keep your Wall Street investments where they are and only move what you want to move for the self-directed into the new self-directed account. By taking that approach, all your Wall Street stuff is isolated from any potential prohibited transaction that may happen on the self-directed front. So it's a safer, more conservative position, and this is your retirement, for goodness sake. So really do what you can to protect it and be safe with that stuff. If we're looking at a 401k plan, that's unnecessary, because if a prohibited transaction were to occur, it's only the money involved with that indiscretion that's treated as a distribution. So it's really a lot simpler thing. So investments wide open. Any investment just has to be for investment purposes. So really what we typically have the opportunity for a problem with is when you're transacting between or for the benefit of a disqualified party. I gave you the example earlier of that purchase sale agreement. And it's just any transaction between or for the benefit of a disqualified party would constitute a prohibited transaction. So I'm going to go beyond this page, because we have another page that talks a little bit more about disqualified parties. But why do people do these things? Why are people interested in self-directed accounts? And I like to say, well, why wouldn't you be? I mean, why do you want to have a full menu of food, or you only want to pick from soup and some form of water, bubbly or non-bubbly, right? Or as they like to say in Italy, gassed or no gas. But if we're looking at the self-directed account, why not have one? And because you never know what you might want to buy. So people typically come to us because they want wider investment options, greater financial control. And what I mean by that is they can literally buy what they want, when they want, as they want. They don't have to go, if they've got a checkbook IRA, they don't have to ask anybody to do it. They're just going to go make that purchase. It's really an instantaneous deal. It's no different than buying something with money out of your pocket. And a solo 401k plan is going to work the same way. Invest in what you know. Now, unless you're, a politician, you're not allowed to invest in stuff. Insider trading's a taboo for anybody other than our politicians these days, which is really a sad state. But you can't use specific knowledge of something that's insider trading. Now, if you're a mortgage broker and you want to self-direct your retirement account and make loans with that, you can do that. So why wouldn't you want to reduce that risk and increase your yield and take advantage of your knowledge that you've worked so hard to attain? Increased investment flexibility. Once again, why not have a menu of options that's virtually unlimited? The next one is real investments, not alternative investments. This is another one of my pet peeves when we get to this topic, because for some reason, anything that Wall Street doesn't sell is considered an alternative investment. So can anyone out there name older investment than gold, silver, or let's say real estate? I mean, these are the oldest investments known to mankind, and yet they're called alternative investments in the investment world. I think that's ludicrous. I call them real investments, not alternative investments. And by the way, if we go down the couple bubbles down, what are those things? Tangible assets. They're great hedges against inflation. And any time we're in recessionary times, there's a flight to quality, and tangible assets rule that space. So once again, why not have that opportunity? Community-based investing. What do I mean by that? If you want to take advantage of something local, you can do that. So you see an opportunity around the block from your house. If you want to go, buy a piece of property because everything else is growing, and you see that opportunity, or maybe you want to do something, buy and build something that's going to be an asset for that community. You can do that. Furthermore, as far as where the money is, your account, you can open a bank account at the bank of your choice with the people that you know. So the money's not across the country with some firm that you don't know anything about. If you like some community bank, use that bank for your checkbook IRA account or solo 401k account. The money is literally where you put it. Take advantage of today's opportunities. So as things change, different opportunities may appear or disappear, and a self-directed account's literally going to give you the opportunity to go do what you want, when you want, as you want. And then finally, security. And that security comment is one of those things. If you buy an unencumbered piece of property with your retirement account, how does that thing go away? I've got a good friend that once again, one time we're in this presentation in a morning group I was going to, and he talked about, if you bought Coca-Cola in the 40s, it would be worth this today. And I said, well, that's great comment. I understand what you're saying. But how many of those companies that you could have purchased that same day are still in existence today? So how does an unencumbered piece of dirt go away? It might fluctuate in value, but it's not going to go away unless you just flat out stop paying property taxes. And even in that situation, it's going to take a period of time for the government to say, okay, we're taking it from you. So if we're talking about doing one of these transactions, you might, let's say, be at a party sometime and you're talking to your real estate broker and say, well, gee, I wish I had money to go do this. And your broker, he or she, if they have a knowledge of this opportunity, might say, well, yeah, use your IRA. And it's like, okay, well, yeah, I want to go do that. Once again, make sure it's set up, ready to go before you're moving forward. But you might take that conversation to that party to your CPA or to your lawyer and say, hey, I've been told I can do these things. Can I do it? You might talk to your financial advisor. The same thing's going to happen. And what happens is there's so little information out there that it's just not well known. And so people, they have a tendency to move away from it. So typical objections might be, well, why would you want to take your retirement account and go buy a piece of property with it? Because you're going to lose long-term capital gains tax treatment on that future sale. Well, that's a true statement, but there's not an investment you can make with a retirement account that's going to give you long-term capital gains tax rates, because you pay tax on these things as you take distributions out of the account. Now, it's possible for an IRA, even a Roth IRA, to have tax exposure on a given investment. An example would be if you went out and bought a piece of property and you got a loan on that property. one, it's got to be non-recourse debt, but if it was, let's say, 50% loan to value, the government doesn't want this tax privileged money competing unfairly with the tax world. So the income and gain attributable to the equity with a Roth IRA would be tax free. The income and gain attributable to the leverage, other people's money, you would have tax exposure on. So in that situation, and I need to be careful, it's not you that has the tax exposure, it's the IRA account that has the tax exposure in that situation. So leverage investments, you can have tax exposure, the account will have tax exposure, UBTI, unrelated business taxable income. The other situation you're going to have be subject to UBTI is going to be, let's say you conduct business with a retirement account. So once again, the government doesn't want this qualified money, this tax privileged money competing unfairly with the tax world. So something that happened years ago, I had a client that bought a large apartment complex. The apartment complex had a laundromat, and he goes, boy, I love the laundromat. So the laundromat is part of the apartment building. That's an investment. The laundromat as a business is a business. So yes, he could make that investment with the IRA, but you're conducting business with it, and the retirement account is going to have tax exposure based upon what it's doing. It's not an investment, it's a business opportunity. So just be aware those things are there. And whether you have tax liability on something or exposure on something or not is really, it's not a reason to do or not to do a given investment. It's just another factor to pull into that ultimate return on investment calculation, right? Second objection, cannot be leveraged. Well, that's totally untrue. You can leverage any IRA or 401k. And as I just said, it's just got to be non-recourse debt. And if we're talking in an IRA context, you're going to have tax exposure on the income or gain attributable to other people's money. With 401k plans, you do not have that situation. So, yes, you can get leverage, you can get loans. It's just got to be from a lender that specializes in non-recourse IRA 401k compliant loans. You can take a look, for example, online at myiralender.com or iralending.com, and you can read all about that stuff. What about RMDs? Now, one of the things about, let's say, real estate or a note, for example, or typically self-directed investments are maybe not that liquid. Well, liquidity gives sort of the roller coaster that Wall Street offers, right? That's due to the liquidity in a marketplace. I mean, people day trade, so these incremental ups and downs. So that's the great thing about your ability to do that with Wall Street stuff. When we're looking at the self-directed world, typically we're looking at hard assets, and the liquidity of those assets is much, much different, much lower. So you may have whoop-de-doos, but they're much longer sweeping changes in value. And where people that don't understand this process often point, well, gee, you don't want to have all your money tied up in some piece of property, because what happens, you get to 72, you've got to take an RMD, required minimum distribution. That's what RMD stands for. And if you don't take that RMD, you're going to have a penalty. So you're going to get yourself stuck in a situation where you might be penalized because you didn't take the RMD. Well, if you were in that situation, and what I tell people, if you, let's say, said, hey, I need 200,000 to go buy this piece of property, I'm going to say, let's put 240 into the account or something like that, because it may be a while till the property's cash flowing. You may buy it. And when was the last time anybody out there bought a property that didn't need something done? So you want to make sure you get enough in the account to make the initial investment, covering and carrying costs until it starts growing for you. But and then furthermore, when we get the RMDs, typically an RMD in the Wall Street world, an RMD is always going to be in cash. Well, in my world, in the self-directed world, an RMD does not have to be in cash. It can be actually taken in kind. So not only is this objection not a problem, it actually provides a tremendous opportunity, because if you look at a required minimum distribution, think of a piece of, a stock. A stock, you know what the value of that is any given minute or second, pretty much. And so you always know what's there. It's easy to calculate what's in an IRA and what the value of all that stuff is. When we're talking about real estate, it's subjective. I mean, it's really, I mean, if you're a broker out there, I'm sure you've lost deals due to an appraisal you didn't like. Well, ultimately, a property's true value is what the buyer and seller agree to it being worth, right? I mean, that's the bottom line. Is it's going to be subjective, and it's never black or white. It's going to be the highest best use. So when we're looking at those RMDs, in-kind distributions, typically you're going to look at what the value of the account is. They're going to slice it up over whatever the term of the life table states, life expectancy is in that given year, and that's going to break down to what you have taken a given year. Well, that's why if you're a broker selling an investment to somebody with an IRA, you need to be in touch with them every year because they need a valuation of that property annually, professional opinion of value. Now, if you're taking an in-kind distribution, what you're doing is actually taking a piece of that thing's value. If you take an entire property out in a given year, typically a custodian's going to want to see, let's say, some form of appraisal done, because there's obviously an opportunity to say that property's worth less than it is. And as soon as you take the property as an in-kind distribution, now you're looking at a lower tax because you're taxed on what you take out, and now it's yours. And now going forward, since it's yours, you can then use 1031 to kick the tax liability down the road. So there's obviously that tendency to say, oh, well, hey, it's worth less than it might be worth, but you've got to validate that value every single year. If an asset's taken out in kind of one swooping movement, then an appraisal is typically going to be necessary. Your tax people are going to want to see a hard value there anyway. But what's interesting is if you're taking a fractional distribution, so instead of taking the entire property out, maybe the appraisal is not necessary, maybe the professional opinion of value will suffice. But there's another benefit to that in-kind distribution. If you take a minority interest distribution, it may be possible to actually discount the value of that distribution by up to 40%. And you're saying, well, why is that the case, David? Well, in, once again, the 1031 world or the taxed world, it's used for estate planning all the time. So if I gave my daughter a property, for example, if I gave her the entire property, I just gave her all the equity in the property, and I'm going to probably have a huge tax hit in that situation. Now, if I gave her, let's say, 20% of the property, she can't do anything with it. If she says she doesn't want it anymore, she's got to convince dad to sell that property for her to be able to do anything with what's there. So her 20% is not worth 20%. Her 20% is worth 40% less. So it really makes a huge difference. And so that discounting is used in gifting all the time because they don't have control. And that same discounting can be used in-kind distributions. And when we're looking at in-kind distributions, if we're looking at a piece of property, for example, we could take the in-kind distribution either by deeding a piece of the property out, or I actually much prefer having the property owned by a limited liability company doing a simple assignment of membership interest. So that's an easy way to convey ownership, taking your in-kind distribution simply by doing an assignment of membership interest in LLC. The title doesn't have to be changed all the time. If you've got lease agreements or anything else, all that documentation doesn't have to change every time there's an in-kind distribution. So once again, 3, it's not a problem. It's potentially a great opportunity. And then finally, once again, why would you take your IRA and go out and buy this stuff with your IRA when you're going to lose interest, deductions, depreciation? Well, once again, that's true, but there's nothing else you're going to buy with an IRA that's going to give you those things. And I say true for the most part. It's not entirely true, because if you've got typically, if we're looking at, once again, the tax world, we're always looking at basis of gain. If we're looking at the IRA 401k world, we're just looking at paying taxes, money comes out, or we could have tax attributable to that leverage, for example. But if we've got a situation where there is a loan there, then we do have something we can offset income with by taking deductions and that depreciation. So once again, this stuff starts getting more complicated for your tax preparer, and you need to be working with a tax preparer, CPA preferably, that understands this stuff and is comfortable working with it. And we spend a lot of time talking to different tax and legal professionals about all of these different topics, just to make sure that our people are getting where they need to go. So what investments are possible? We've talked about this earlier, but just to reiterate, it's literally endless what's possible. The only restrictions, unless it's specifically prohibited, is therefore allowed. The only restrictions for an IRA are collectibles, life insurance contracts, or stock in a sub-S corporation. and the only restriction for a 401k plan is collectibles. So you name it, you can probably buy it, and any investment, just any purchase just needs to be for investment purposes. So once again, rarely is the investment a problem. What triggers problems for people is transactions between or for the benefit of a disqualified party. So who's a disqualified party? Who or what is a disqualified party to your retirement account? Well, you would be your lineal ascendants, descendants, their spouses, or any legal entity owned in a controlling interest by one of those. So it's really important that you don't do anything that's going to benefit a disqualified party. So let's say Johnny's going off to college. You want to use your IRA to go buy Johnny an apartment, apartment building that Johnny can live in. Can't do that because Johnny's a lineal descendant of yours and therefore a disqualified party, which would then constitute a prohibited transaction. You can't buy mom a condo near the beach to live in. Same issue exists. You can't go buy a second home that you're going to use once in a while. I mean, years ago, I had somebody, they wanted to take a 401k plan and go buy in Mexico, and they ultimately did. But I kept stressing to him. I said, look, you can make this investment, but you're not going to use it. You can't work on these things either. So working on a piece of property, that sweat equity is not okay. You can't go out and swing a hammer or wield a paintbrush on a property owned by your retirement account, because that, once again, is a benefit to a disqualified party and therefore a prohibited transaction. Another situation that might come up is you might buy the property using your retirement account. Now the property, it's not yours, and I've got to stress this. Anything owned by your retirement account, do not think of it as yours. Think of it as somebody else's. They like say, Susie down the street, it's hers. You're not going to pay for insurance. You're not going to pay her mortgage. You're not going to take the rent that she's generating off the property. It's hers. And think of the retirement account as Susie down the street. And we really stress that. Even when you're coming down, if you're doing a checkbook IRA with us, people have a tendency to want to name that limited liability company using their name somewhere in it. We discourage that because I don't want any confusion. If you pull out that checkbook IRA checkbook, you need to understand when you look at that thing, it is not you. And so you're not going to pull the IRA checkbook out or the IRA debit card out when you're going through McDonald's and, for $12 you just blew up your IRA. So it's important that you respect this thing, understand it's not you, it's there for your retirement account. And in general, I got to be honest with you, I might have a client we've done 1031s with for 20 years, and then I've never seen them. And then they come in because they're doing a retirement account with us, and they come in the office. And I said, well, why are you here today? And I said, well, this is my retirement. So I think in general, people are more cautious with their IRAs and 401k plans. At least that's my experience. But we still have some situations occur that are really sort of crazy. It's like, well, what were you thinking? Why did you do this? I mean, this is not okay. So it really just keep any of these transactions away from any of your family. Now, what's interesting though is I didn't say anything about siblings, aunts, uncles, or cousins, did I? So believe it or not, your brother or sister is not a disqualified party, nor would your aunt, uncle, or cousin be. So a lot of times, if you got a situation where you need to go take advantage of a transaction, you haven't gotten the account set up yet, let your brothers, have them go buy the thing or tie it up, and then you can have the transaction assigned over to your retirement account when it's ready to go. And one other comment I want to make is that any transaction between or for the benefit of a disqualified party is a prohibited transaction, but transacting along with a disqualified party is fine. So on this slide, examples of prohibited transactions. We talked about the assignment purchase sale agreement, recourse debt. That's one of those things all the time. And it's possible you could be a co-owner of a property along with your retirement account, as I just said. But don't think, well, gee, we're going to go out and get a loan on this property and it's only recourse to me, it's non-recourse to my retirement account. Well, no, you got the loan because you allowed recourse to you. So if you're a co-owner of an asset along with the retirement account, it still is going to require non-recourse debt, period. Okay. Contributions, distributions directly between the IRA, LLC, and the account owner. So when we put a checkbook IRA together, we've got a slide talking about this in a few minutes. But what happens is we're going to move the money from trust company A to trust company B, and then after that's happened, we will actually, as that's happening, we'll be creating a limited liability company, getting you the articles, the operating agreement, which is IRA specific, and the federal tax ID for it. Now, as soon as we get that information to you, you can go up and open a bank account in the LLC's name and EIN. It's a manager-managed limited liability company. So you're the manager, the member of that limited liability company is a trust company for benefit of your IRA. And so what happens is after the custodial account's been opened and funded, and the IRA LLC has its bank account, then we're going to direct the trust company to make an investment into the LLC, which then funds that bank account. All right, and from that point forward, to make any investment, you just go out and buy it in the LLC's name, you write a check or wire funds. This is out of the LLC. Any income off of that investment goes back in the account, and the expenses paid out of it. And you're not going to have any tax exposure if it's an unencumbered property until you take distributions of money at some point. So everything goes in and out of the LLC. Now, you might say, well, gee, and a lot of our clients start off the account maybe with a smaller amount of money. They're dipping the toe in the water, and then they want to add more funds to make more investments later. And they might make just a direct, move their money straight from the IRA account straight in the LLC, or the LLC maybe take a distribution out, or maybe they just decide they're going to put money into the LLC without going through the trust company contribution. Well, all those things are prohibited transactions. Everything has to go through the trust company. So any contribution has to roll through the trust company to the LLC. Any distribution has to go from the LLC's account through the trust company to you. So that has to happen every transaction. Any contribution, distribution, you're engaging the trust company, moving money through them, and it's all being recorded and taken care of. Now, unfortunately, with checkbook IRAs, sometimes those contributions and distributions go directly in or out, and either of those events constitutes a prohibited transaction. So don't do that, all right? Working on IRA-owned asset, we talked about that. Sweat equity is not okay. You can do the administrative functions of managing an asset. You cannot go out and work on the thing. And one other comment I guess I should make too. As far as, like, for example, you buy gold. It's got to be segregated. You can't just have it in your house, okay? I want to be clear on that. So typically you're going to have a custodial arrangement somewhere that they're going to have it. Now, there are people that will have a checkbook IRA, and they'll buy a safe, or if they've got a safe deposit box, it's in the safety deposit box is in the LLC's name and EIN. It's not in your safe deposit box. So once again, we've got to segregate. It's got to be clear, okay? And don't go out and buy a car as an investment. I mean, how do you register it? Who registered it? How do you get it where you got it? Where is it being stored? All those things are problematic. And once again, if it's a collectible car, that's just not okay, period, to do, because it's a collectible. So you really got to be careful with stuff when we're talking about coins, crypto, or not cryptocurrency, but let's say precious metals. If you're buying coins, it's got to be a specific quality. It's got to be, it can't be a collectible coin. It's got to be a high enough quality, purity to qualify. So don't just go out and buy the stuff. Make sure you're working with the gold or silver, gold, silver, palladium, any of these, might be platinum. Anybody that specializes in IRA 401k compliant precious metal investments, that's who you want to work with. You don't want to just talk to your friend and go buy some coins, because that could constitute a prohibited transaction. We talked about using an IRA-owned asset, not okay. Buying from or selling to a disqualified party, not okay. Use of taxpayers' personal insurance policy for an IRA or 401k owned asset, those things are not okay. So if you go out and buy a property, the insurance has got to be an insurance policy for that LLC, and period, and funded by the LLC. It's not going to be an additional binder for your homeowner's policy. So, and once again, in this bold at the bottom, generally a prohibited transaction in connection with traditional IRA account at any time during a year results in dissolution of the IRA as the first day in the year in which that indiscretion occurred. And then once again, my Susie down the street comment, don't think of that IRA owned asset as yours. You start thinking of it in that context, I think you've got a potential for problems. Just think of it as somebody else's and you're going to be a much, much better situation. So how do I do this? You know, earlier we talked about this a little bit. This is a little bit more in depth here. And you know, the reality is that it's pretty simple. If you're working with us, you're going to fill out a 2-page application. You're going to return that application along with a copy of a photo ID, your current account's most recent statement, if we're talking IRA to IRA. And then we're going to take that information, merge it in a series of forms that allows us to create the custodial account and then ultimately create the limited liability company. So when we're looking at the LLCs, it's important to understand, you know, where you want to have that thing registered, you know, what state of registration you're going to have. So typically we're going to decide that 2 ways: 1, where you live, or 2, where the investments are being made. Some states have foreign investor rules that make it much more attractive to have a domestic entity in that state. So just keep those things in mind. And once again, when you're naming the LLC, we don't want you to use your name. Come up with something clever, something that is going to make you think every time you look at it, hey, this is not me, this is my retirement account. So the forms that we're going to fill out, and one of the forms is a transfer authorization form. So we're talking IRA to IRA. The new trust company is going to reach out to the old trust company and say, hey, give me the money. So it's important that you've gone to cash before that request occurs, because otherwise they'll just bounce it and you're going to be sitting there waiting. So once again, this is not an all or nothing situation. I'm going to tell you, just move what you want to move. If we're talking about IRAs, only move what you want to use in the self-directed realm into this new trust account. Don't move it all and then have to reestablish your investment accounts with your current advisor. It's just a lot of extra work, and it's not as conservative a transaction. So just move what you want to use. If we're talking about a 401k plan, I'm going to tell you to move everything into the new plan, then just reestablish accounts with your advisors. It's just, why have multiple plans? I mean, it's just additional costs and reporting that's unnecessary. So this is what a checkbook IRA looks like. And if we look at on the left side of this bubble chart, you've got maybe you're rolling a previous employer 401k plan in the new custodial account. Maybe it's an IRA, maybe it's a Roth IRA, maybe you've got traditional and Roth IRAs, maybe you've got a SEP IRA. You know, you're self-employed, and a SEP's going to give you, a greater ability to make contributions. So we can create a checkbook IRA with any combination of different accounts. Maybe it's you and your spouse. So we will often, for retired people, combine his and her accounts into a common IRA LLC, or maybe you've got, like I said here, you've got an IRA that's the traditional and Roth funds you want to move into this IRA LLC. So we'll have to create a custodial account for each type of account. So if you got a SEP, you're going to need a SEP account. You got a traditional IRA, you're going to have that. I question why you have both of those. But if you got a Roth, you're going to have another custodial account for that. And then each of those custodial accounts, you're going to make the investment into the IRA LLC. And those, if it's a single member IRA LLC, then we can always add funds later, no big deal. If the IRA LLC has multiple accounts, then even your traditional and your Roth are considered disqualified parties to one another. So if we've got multiple IRAs or multiple member IRA LLC with disqualified parties, then we want to make sure that we're funding that initial investment with more than you think you're going to need, because things come up once in a while, and after that initial funding, our typical position is you shouldn't be adding more funds to that LLC. Now, if for some reason you had to, any additional money going into that IRA LLC has to come in pro rata the current membership interest. So if it's 33, 33, 33, and you need more money, you've got to add 33, 33, 33, and all additional funds coming in. You cannot skew the membership. If you skew the membership, that's a prohibited transaction. So that's why I say put more money in initially than you think you need, just to be conservative on it. And that's a more conservative way to do it. The trust companies will make additional investments into that multi-member LLC, but once again, it's got to be pro rata membership interest. After that investment in the LLC has been made, you're the manager of that LLC. The member would be typically the trust company, CFBO, custodian for benefit of your IRA number, whatever it might be. So as soon as the IRA LLC's bank account has been funded, now you're free to go make the investments as you choose, and it's really, you're working those investments just as you would money out of your pocket. You're just going to buy and sell everything in the LLC's name, and any income that goes in the LLC is the LLC's, any expenses paid out of the LLC, none of this is you once again. So they work wonderful. You've got, you know, liquidity of investment. You buy what you want when you want, as you want. You sell what you don't want as you want when you want, and it really, it's a great situation. If you're only making a single or infrequent investment, and those investments are non-time sensitive, nor do they require any management, then the checkbook IRA is really unnecessary. So this one just shows multi-member, just talks about, as I said, blending multiple members into a common LLC, and those members could be disqualified parties, or they could be multiple IRAs by people that are not disqualified parties to one another. It really doesn't matter what's going on. If it's a multi-member without disqualified parties, then we don't have to have that pro rata investment with additional funds into the LLC at any point. But if it's all qualified money, IRA, 401k funds, and disqualified parties, we really need to be careful with what we're doing going forward on it. So if you're self-employed, I'm going to sort of steer you at a 401k plan instead of the IRA, and that's for a variety of reasons. One, as far as simplicity is concerned, they're wonderful too. They're more forgiving because once again, if you make a prohibited transaction, you don't have tax exposure on the whole thing. You've got pretty much the highest contribution limits that are possible short of a defined benefit plan. In plan, you can do in-plan rollovers from traditional to Roth. That's an easy deal. They're self-trustee, so you're just going to have a bank account in the plan's name and EIN, which we will have provided both to you. You're the trustee of the plan. As trustee, you make investments just as you would with the checkbook IRA. So investment simplicity is the same way as the IRA LLC or checkbook IRA, but you don't have to have a trust company involved. As far as UBIT on leverage, you don't have it. As I say, you don't have to have a custodian. You can invest literally in anything other than collectibles. And the other thing about a 401k plan is you can actually borrow from that account. You can borrow half what's in it to a max of $50,000, and that is not possible with any form of IRA. So they're really pretty neat deals. So is it possible to combine personal plan funds into a common investment? Yes, obviously. We've been talking about that for the last few frames. If we're talking about doing it in a piece of property, for example, you've got two options there. You've got the option of doing it tenancy in common, which gives you the opportunity downstream to actually sell and personally do an exchange while the qualified money goes back into its account. Or you can do it, actually, the tenancy in common structure is nice because it gives you that flexibility to do that. And by the way, if you wanted 1031 into a property that's going to be jointly owned by your retirement account and you personally, that's going to require the tenancy in common structure. If you're just going to go out and buy something, the LLC structure is simpler typically because and it also, because it's just one thing that's there. The downside of the LLC is additional money needs to come in pro rata, and well, the same thing's going to happen tenancy in common. But as far as distributions, especially in-kind distributions, that ownership via the LLC is great because you're just doing a simple assignment of membership interest until it's all yours, and you're not changing title. The title policies stay in place and everything else. So, the downside of the LLC structure is that upon a sale, if you're in there along with your retirement account, the entity, you're going to have tax consequence. The entity's going to have to do an exchange, or you're going to have tax exposure. So, that's a downside to it. But anything's possible. We do a lot of transactions where people put investment funds together, and those investment funds, so we're talking a whole bunch of people buying into things, and typically those investment funds are in the form of a limited liability company or a limited liability company or limited liability partnership, LLP or LLC. But that's going to be when we're talking about putting money together to buy notes or maybe to buy a property, and we're aggregating funds from multiple different parties, non-disqualified parties. That's typically a structure that's going to be used. A few examples and we're done. So this is a situation where somebody just came in and they were first interested in just doing this investment. Opportunity came up, path of progress, land, and it's sort of funny because I've been handling exchanges for almost 33 years now, and we're always typically working with income properties, right? But it seems like the biggest home runs I've always had with people have always been land plays, path of progress stuff. I remember years ago there was a guy that drove a dump truck that picked up a property for I think it was $125,000, and I think 5 years later it was like $1.5 million. So why did you buy that property? Well, I kept driving by it and saw it and said, hey, I think that thing's going to be worth something someday. So I went and bought it. So that was a great story by somebody that really didn't have background in investing at all, but he just saw value there. So in this situation, this is path of progress stuff, and it really, and these are deals that we just did, where some regional investment people that are very successful had decided they want to tie up a piece of property, and they know it's going to be probably a few years till it's a home run. But using a group of people to buy it, and especially with retirement money, people aren't going to live off that money, so they don't mind a long-term hold. And so what they did is put a limited liability company together, and then people were coming to us wanting to buy into that offering. And so in that situation, for most of these people, it was a non-time sensitive transaction that did not require any management, and it was a one-time deal for them. So we just put basic self-directed IRAs together. They did not need the flexibility of that checkbook IRA, IRA LLC, nor the need to spend the money on one of those things. So a basic account is very inexpensive to put together, and that was all that was needed. And it allowed those people to make those investments into that land play that was probably going to be maybe a half dozen year hold on it, and it worked very well for those people. This is a transaction that is sort of the opposite. The last one just happened. This one is 15 years ago, and in this transaction, what happened is we had somebody that came into us initially. They thought they'd go buy a mobile home RV park, but it's somebody that really was sort of tired of the terrible T's, trash, tennis, turnover. So they started thinking about, when they realized we'd gone through what would need to happen for the mobile home park, and they started asking questions about, well, what else is possible? And this is somebody that was very well heeled and a sophisticated investor, and so he had contacts in the hard money world, and this is during the last recession. And so he came to us and said, well, look, I think I'm going to pass on the mobile home RV park right now, but can I buy notes? And I said, yeah, sure, fine. And this is an example of sort of getting his feet wet and then going further later. So this guy, the first investment that he bought was it was only a $70,000 property at that time, paying 11% at 50% loan to value. So that property pre-crash had been worth $250,000. It had gone down to 70 for $35,000. He was going to get 11%. And in his words, I mean, and the next transaction he did a bunch of these. But then ultimately, the largest one he did was about $1 million deal, and I think it was $900 and some odd $1,000 in a wind power plant, and it was they only needed like a 10% loan or something like that, but it was paying 19%. So he was just cheering them on to default. And so this is an example of getting his toe wet, trying it out. Hey, this works well. I like it. And slowly migrating more money in as the opportunities appeared. And once again, I guess if you look at hard money stuff, I guess you got to sort of look at it. General rule: never anything but a first, never for any more than you'd be happy owning the asset for. This example is one, if you've been in my classes before, you've seen it before, so I apologize, but I just love it. And this is an elderly couple. They came into us, and they also wanted to buy a mobile RV park. And they, our first comments were along the lines of a checkbook IRA. So an IRA LLC with his and her IRAs as the members, and that would allow the investment to be made. Well, as conversations went forward, it became apparent they wanted to not only make the investment in this property, but they wanted to manage it, and they wanted to live there and be compensated for it. Well, all those things would constitute prohibited transactions in the IRA world. So we had to shift gears entirely. And instead of doing a checkbook IRA, we did what's called a rollover business startup. And instead of a combination of an IRA and a limited liability company, rollover business startup is a combination of a 401k plan and a C corporation. And what happens is we moved both of their IRAs into the new 401k plan. The 401k plan bought the corporation bought the park. They got a job, a place to live, and an investment all with that one transaction. Now, the ROPS process, once again, is not new, and the franchise world has figured this out. So we've used the roller business startup process for everything from gold, silver, palladium mines to mattress companies, to hotels and motels. All kinds of different things are possible there. So it's a great thing to understand. And anytime we're in recessionary times, people lose jobs. Maybe the only avenue forward for them is their retirement account, and they're faced with the possibility of having to take the funds out and paying tax on a full distribution of all funds. Or by using this process, they don't have to pay the tax on the funds. They're not distributing funds. We're just creating a new plan where that's going to allow them to get where they want to go. So here's your IRA 401k investors checklist. Plan ahead takes 2 to 4 weeks to establish your self-directed retirement account. You can purchase virtually any investment with an IRA, SEP IRA, Roth IRA, or 401k plan. You can purchase with family members and friends, cannot purchase from or for them. Your IRA cannot sell to you or any other disqualified party. You can use an IRA to buy a property with a mortgage, negotiate from the deal's inception in an IRA, IRLC, or 401k plan's name. Do not overextend. Plan on keeping a nice cushion of reserves. I thank you very much for your time today. I hope you found it helpful and useful, and I encourage you to give us a call. Don't just text us or email us. Give us a call and talk to us. If you've got some ideas and you want to bounce them off us, we're happy to talk to you. And once again, if you're looking for CE for this presentation, reach out to cmore at 1031exchange.com, CMOORE at 1031exchange.com. And one final comment is that there is a brief glossary at the end of this packet. If you want the slide deck, also reach out to Celia and she'll get it to you. And I look forward to speaking with you soon. Thank you. David Moore, IRA Advantage. Bye-bye.